very warm welcome to Prabhanjan and to all the viewers of Talk of Town Beyond Boundaries for the market outlook for the week ahead. Was a tough week for the markets, Prabhanjan. Let's accept that. Indian markets had quite a bit of selling pressure, and while the other markets, especially silver and gold, continue to rally and show their strength, Indian markets have, last week gave us a ray of hope while we were still cautious of it, while people were like trying to identify stocks and sectors that would kind of break out and find an oasis in the middle of the desert. All we had suddenly we had a severe selling pressure, especially the last 2 days has been quite brutal for the markets. So we will see what the charts are saying. We'll check with Prabhanjan how the fundamentals are panning out and get an idea as to how we place our bets for the next 1 week to 10 days. Now that the festival season has officially kicked in, we will see if there is any respite for the markets and if there is, what kind of sectors we are looking at and what sort of stocks that we will be looking at investing in the next short long term in the market. So welcome Prabhanjan, over to you. First we'll start off with, as it is customary, we will start off with the global markets, and we will, and in the absence of Lakshmi, we will still try and make the podcast interesting to our viewers.
Great. So, good morning, Ashwin, and good morning, market warriors. Since this is a cricket season, cricket analogy to banta hai, boss. So, if markets were the cricket, this week felt like India-Pakistan clash. Uh, Tense overs, surprise bouncers, and the crowd holding its breath till the last ball. Ashwin, today's update has all the drama of a supercharged rivalry, especially with US. So coming on
Absolutely.
to the main,
Just to interrupt you there, Prabhanjan, the reason why Lakshmi has been skipping all this session is because he's undergoing a cricket practice session for
right,
the tournament that is coming up. So, because you said it's cricket analogy, I thought it's only apt for me to talk about Lakshmi and his absence. So, please go ahead, Prabhanjan. How is the fundamental factors on the global markets looking like? And it would be nice if you could also touch upon the Indian domestic fundamental factors in continuation to the global factors, and then I'll probably take up the technicals of both the global, the commodities as well as the Indian markets.
absolutely, absolutely, I will do that. So on the main parameters, let's start with the crude. It's hovering around 66.6, more or less is relatively stable. Dollar index, quite interesting. It has moved up a bit from 97 levels last week to 98.2 levels. Rupee, what a week it was for the rupee.
Hmm.
It weakened to 88.71 levels. It depreciated from 88. Wix, as expected, it is up to 11.4 from 9.8 to 10 levels last week. On the Friday itself, it is up by 5.5%. On the CBOE Wix, it is 5.29, more or less on the same levels. Gold claimed as safe haven. It's about 3,734 levels per ounce. 10-year GSEC 4.082. It has, the yields have increased 4.17. This is a point to be noted before the Fed
Yeah,
commentary.
yeah,
And how can we forget about this Bitcoin? We are seeing a steep, I would say a consolidation, not a correction,
yeah,
to around 109.72 levels. It was trading around 115 levels on
yeah.
last Friday. So, if you allow me, then I will also want to touch base upon the Bitcoin because that also
Yes,
seems
please. Yes, please. I think a lot of viewers are very anxious and eager to know about how the Bitcoin is panning out, considering the volatility that we have seen in the last couple of sessions.
absolutely, absolutely, because this also has got a fundamental bearing on the global factors and
Yeah,
inflation
yeah,
factors. So markets may be bouncing back in US, but the Bitcoin is given sort of a textbook lesson in volatility, hitting around 109 levels. The cryptos isn't just moving; it's teaching us why leverage, the sentiment, and the macro interplay matters more than ever. or 1.7 billion in leveraged long positions got liquidated last week, wiping out speculative bets almost overnight. On top of that, $23 billion of options got expired in the Bitcoin, forcing traders to rebalance aggressively. And while the tech stocks and the risk assets held up, strong US economic data reduced bets on Fed rate cuts, pulling some momentum away from the high risk assets like Bitcoin. You know, and this is, I would say, it's a market pruning, not a structural collapse in the Bitcoin. Large swings are uh, clear out the weak hands and over leveraged positions. Leaving room for healthier, more sustainable growth.
Hmm.
Technically, Bitcoin is consolidating around 108 to 109 levels, a key support zone, a breakout zone about. A breakout about 113 to 115 could reignite the momentum towards 120, and even analysts the experts believe that it might go up to 135K, especially if institutional ETFs inflows pick up. So this is about a Bitcoin which has got a lot of bearing. I mean, sudden consolidation and crash in the Bitcoin. Coming
I
to
think,
the
just to interrupt you there, I mean, we are at times wherein, whether you like it or not, it's an instrument that you cannot ignore. We just have to continue tracking it, because over a period of time it becomes an inevitable part of many people's portfolio. See, look,
absolutely,
for example, I am not a person who was very comfortable trading Bitcoin. I've stayed away from it, but there might come a time wherein having Bitcoin as a part of your portfolio is inevitable, right?
right,
I think that's where, instead of suddenly trying to gain knowledge overnight, it's ideal that we start tracking Bitcoin and its volatility, because it's an instrument, a different class apart. The volatility is of very, very superior levels. I mean, we have seen silver, gold, and all crude, move 5-6% in a day, intraday between the high and low. But Bitcoin is of another level altogether. So, accustoming yourself to the, it's like a climate change when you're climbing the mountain. So it's a,
absolutely.
we'll have to start getting accustomed, accustomized to the volatility, if and as and when we have to get into trading that instrument eventually, when it becomes completely a tradable instrument. So yeah, sorry, go ahead.
Absolutely. I mean, you have very rightly pointed out and voiced how we need to trade, how we need to place Bitcoin in our portfolio. Because when we talk about Indian an average investor today, he has exposure to some commodities like gold and silver.
Yeah,
So Bitcoin also is one of the things which can act as a reasonable hedge towards the equity exposure. I think I mean, we will be seeing that stance where we will always be looking as Bitcoin as a sort of a hedge. And
yeah,
of course, it is not that prevalent in the Southern Asian economies, but very soon it will catch up. So on the global equity performance, Friday's rally in US helped. Dow was up 0.65%, S&P 0.59%, Nasdaq was up by 0.44%. But if we see further weak as such, it's slipped slightly. S&P slipped by zero point 0.3, Nasdaq by 0.6%. On the If we put the money into perspective, global equity funds attracted about 28.4 billion inflows, which was the other way around in the last week,
yeah,
reversing sharp outflows. Bond funds also saw a huge demand of about 23 billion inflows. Money market funds bleed nearly about 13 billion, showing a risk appetite is back. What are the major drivers driving this global trend? Is number one, US inflation and spending yields. US inflation is steady about 2.7%. Core PCE is about 2.9%, with in line with the forecast. The consumer spending surprised on the upside, keeping growth fears in check. Long-term yields rose a bit slight, as I said, 4.08 to 4.1718%, pushing up the mortgage and borrowing costs. And another one which we can't ignore is the Fed
yeah,
uh, commentary in October. So Fed officials they caution. They are always on a caution note. They always say don't assume too many cuts too quickly. So it balance is to ease support jobs, but not enough to reignite the inflation. And we can't also ignore the central banks, global central banks divergence in the last week that passed by. SNB kept rates at 0%, citing tariff hit exports. ECB and Bank of England still are very cautious. Sticky inflation keeps them from cutting. China's PBOC pledged stronger liquidity support and fiscal coordination, quite very unusual of China, central banks. Now, we can't ignore again the geopolitical and trade. The big one this week, which I will touch upon when I talk about the Indian impact. US in unveiled new import tariffs on 100% on the branded slash patented pharmaceuticals, effective October 1st. 25% on heavy trucks, 30 to 50% on furniture and cabinetry. So these are all the impacts which has had a big jolt on the Indian markets. Why India reacted is obviously the US is in India's largest pharma export, about close to USD 10 billion annually. But one point to be noted here is most of the exports are generics and not branded or patented drugs.
Yeah.
So what are the risks ahead is because of all these factors, the rupee volatility has increased, which has added to another layer. Uh, last on the global front, which we can't ignore, is the yield curve and the capital flows rather. The US curve steeped again, long yields up. As I said, 4.08 to 4.17 in 1 week is a steep yield up. Investors are now shifting to intermediate maturity bonds, avoiding the duration risks. They are avoiding the long duration and then coming up investing heavily on the shorter duration riskier bonds.
Yeah.
The Fed easing emerging markets like India could benefit from the flows, but if the rupee holds steady, if the rupee is again depreciating, then that also might flow to a different. And imagine, and mind you that Indian rupee is the worst performing currency. We all thought Russian ruble will be worst performing, but Indian rupee has taken its place. It's indeed the worst performing currency. So coming on to the Indian update, uh, of course, Indian VIX has increased 5% on Friday,
Yeah.
and what has happened to the Indian US Indian markets is mainly they are driven by what do you call it as this pharma thing. So
Mm.
on the pharma thing, what we need to understand is uh, there has been a rate tariffs on the patented drugs. But in India, we need to understand how many companies are dealing with patented drugs. They're all in the generics. So most of the, I would say, 80 to 85% of our pharma sector is unhit by this recent move. But the problem is the sentiments. Because of these sentiments, it has the markets has reacted. Again, on the 25% of the heavy trucks, 30 to 50% of the furniture and cabinetry, some of the stocks, which doesn't have a much bearing on the stock market impact, has might go up and down on individual stock levels, but on a stock market perspective, it is more of a sentiment, driven. What are the risks ahead? If you ask me about the Indian markets, is if the tariff later extend to the complex generics or biosimilars, Indian majors like Sun Pharma, Dr. Reddy's, Cipla could face a real pressure. And of course, rupee volatility adds to another layer. Tariff tensions push the rupee weaker, increasing the import inflation risks. So these are the things which keep our Indian markets on a trajectory. Uh, you just name the Fed commentary, U.S. non-farm payrolls, corporate earnings. Yes, starting from October 9th. So how the earnings flare out from October. Uh, RBI's policy in the month of October, the rupee trajectory, how the rupee behaves. These are all the important events in the October month, which will have which we need to have a very close watch on the Indian markets. So I would always say wait and watch all these events, how the events plan out, including the earnings season, the RBI, the Fed commentary, and take the calls accordingly. So for now, we need to wait and watch with cautious optimism, cautiously optimistic.
I think that's very well said. Oh, I mean, more from a psychological point of view, what is happening is uh, we thought gold and silver have kind of peaked out. Uh, we thought, now it's time the money will be moved to equities because they had been on a sideways to consolidation phase. And just last week, when we were talking about a good uptick, a positive close for the week, markets suddenly started bleeding, especially during the second half of the week. And somewhere we all have this habit of over speculating, in the sense that okay, now it's festival season, the markets historically have moved up. Now it's usually between October and December, markets are always on a positive note. It has happened in the past, but I always try and take it with a pinch of salt that these are mandates that we are making ourselves and trying to dictate to the market, and we are trying to convince ourselves to go long or stay invested, while the scenario this year might be different and scenario next year might be completely different. So that's where analyzing the market for what it stands for on that date, or that week or that month, is very very important, rather than trying to take the historical data, because uh, uh, history rhymes, history repeats. But that 1 year or 1 month wherein it fails to do so might be the worst of months, and we might see some severe damage on the portfolio. So that's where we advise all investors and all traders to be cautious on the analytical front. Please go with the data, or the data as is for this month or this year, rather than relying too much on historical inputs as to this is what has happened during festival season, or 5 years or 6 years in a straight. So things might be very very different. We are in a very different volatile phase. We do not know what sort of news flow will come in over the weekend. So it's ideal to be cautious, and if nothing is working out, just look at stocks on their fundamentals. Look at staying invested for the long term. Historically, when you're doing the right thing or investing in the right set of companies, any sort of volatility will be absorbed, or any shock will be absorbed, and the market eventually will prevail. So that's the nature of the market, and that is what we are advising all the investors and the viewers through this channel. uh, Moving to the technical part, let me quickly share the screen. I hope it's visible, Prabhanjan.
Not yet.
Not it.
Not yet.
Okay, okay, sorry. Okay, the entire screen.
Yes, now it's visible.
Right. So clearly, it's evident that the last week we spoke that these are the levels that the market, a simple trend line breach is what we were expecting for the markets to really stay positive. It did respect the trend line and not just hover around it. We saw some severe selling pressure, and now again we are moving back into that supply zone. So it is going to be a slightly volatile phase. When I say volatile, we could have a range between 1.5% to 2% for the week. The moment we hit a 24,400 or a 24,500 on the Nifty in the coming 4 to 5 trading sessions, we might again have some supply coming into the market. Again, markets move up, but again, eventually this breach is what I would really, really want from Nifty to see it, gliding higher without any headwinds, or without any sort of selling pressure coming in. I mean, that's what exactly what we are seeing from the options data here as well. We have spoken about it for the last couple of weeks. 25,000 remains a very, very, very important level in Nifty. We did have a breach of 25,000 2 weeks back, but eventually it's kind of giving up. That's where the selling maximum selling pressure is there. But the good part, there is always a silver lining, is that you are not, there are a couple of big mountains on the downside. It's not like there is nothing on the downside and you can just slide down further. There are certain supply zones at which point in time I believe this selling pressure will halt. There's always a chance of breaking it, and then things will not look very bright for the market. But for now, without anticipating or speculating too many things, 400 to 24,000 levels are something I'm looking at as a major support in the market. And then we will, we will again look at the markets if the volumes are supporting for it to be bought into. In the meantime, having broadly given the view on Nifty, uh, I'm not saying there are no stocks that will move up. There are certain stocks that will outperform the market. Even in a sliding market like yesterday, there were certain stocks which were positive. Please focus on those sectors. There are PSU banks that are on the verge of a breakout. You have metals and autos which are slightly correcting after this sharp up move 2 or 3 weeks back. Put your money on those stocks which give you the best risk reward and which are in the limelight for the good reasons and not for speculative reasons. So that's all from my end, Prabhanjan, for this week. I understand that markets have been very, very tough, especially for a trader who is looking to trade for the short term. By the time he's getting into the markets, placing his orders, all we know is 2 days later the markets are correcting and hitting the stop losses. He's going and he or she is trying to short sell the market. Again, on the upside, the market is triggering their stop losses. It does happen. This is a phase of the market, but having conviction in your trading methodology and your trading system is the most important thing. It is a way of averaging the returns out by the market. There have been times when the market has given superior returns,
Right.
and the average the returns has to come back to the mean or the standard deviation levels, and that is exactly what is happening in the market. Trust your system, trust your fundamentals, trust your trading methodology, and most importantly, keep your risk management in place and your position sizing intact. Eventually, the market is going to reward those who are disciplined. So uh,
Absolutely.
anything else you have to say on the as a conclusion, Prabhanjan?
Yes, yes, yes. One is like, if we see since you mentioned about the risk, one eminent risk, and also I would also call it out as a structural pressure, not a structural risk, but I would call it out as a structural pressure is on the rupee. If you see, the rupee has really, really depreciated from 84, 85 levels. So now we are seeing at 88.8 levels. And there is also, and I always kept on saying that the rupee, the real value of a rupee is around 90 levels. I
Yeah.
think reaching to that stage now. And S&P projects that rupee may slip to 91 levels to USD by FY 29, citing export headwinds and tariff pressures. And I mean, we at Elysian also see that real value of a rupee, and if the RBI doesn't intervene, it's somewhere moving towards a path of about 90 or more by the end of 2025. Especially if this FPI outflows continues. I mean, it has become a
Yeah.
chip like story. Maybe you can see some sort of a return in INR, but not in terms of USD. Because that's one of the reason why FIs are not putting money in India. If the rupee is stable, then that is where I see that there will be a gateway of inflows in India. If the rupee is constantly depreciating, you know who will come and invest in Indian markets. So that's one thing which is our caution in the short term, supply and demand, which might cause a trigger. So we need to be a little cautious on and very cognizant on how the rupee is behaving before we take any calls.
Wonderful, Prabhanjan. I think this adds a lot of value to the viewers and the participants of this podcast. And like I said, we are quite hopeful that the markets will start picking up steam. I have been repeating this, multiple times on a personal note as well as on the podcast that the markets have not gone up, neither have they corrected severely, right? That's a very, very important thing to understand here. Is I know for sure that the market is neutral. The market is definitely not bearish as of now. It's just neutral. It's just like your amber light or orange light in your traffic signal. It can either turn to red or green at any point in time. Just stay cautious. Just be prepared. And having cash at hand is one of the best things that you can do right now as an investor. Hunt for those low risk and high reward opportunities, and stick to your fundamentally sound companies. And I don't think there's any reason why you should be worrying there. And in fact, if you ask me, more the correction, better it is, so that I can pick up the most good quality stocks at the cheapest of rates. So that's what I'm hoping for. But markets never act according to our wishful thinking. Market has its own agenda. Thanks, Prabhanjan, for the wonderful inputs as always, and wishing all the viewers a very happy festival season, and stay cautious in the markets. Keep your risk management in check, and we will see you next week once again around the same time. Thank you, and you have a good week ahead.
Thank you, and have a happy weekend and happy festival season for all the viewers.
Thank you, Prabhanjan. Thank you.
Thank you. Thank you.